Hello everyone, my name is Craig Adler. I'm a retired certified financial planner. I am also sometimes known as the Angry Financial Planner. I am angry because we have made personal finance far too complicated. I have created this channel to address that concern. Today what I'm going to be discussing with you are 7 very basic investment portfolios that are sometimes called lazy portfolios. We are going to look at the similarities, the differences, and what has been the catalyst behind the different results each of these portfolios would have experienced. The main purpose, though, of this video is to teach you, to help you learn how to think like a financial planner so that you can begin analyzing portfolios and determining which structure is best for you. The 7 portfolios that we're going to be discussing today are FIRE, which stands for Financial Independence Retire Early, the Buffett Portfolio, the Ramsey Portfolio, the 3-fund portfolio, also sometimes known as the Boglehead Portfolio, the Bernstein No-Brain Portfolio, the Couch Potato Portfolio, and last but not least, the Coffee House Portfolio. I have listed or I have ranked these portfolios from best performing to worst based on annualized returns for the decade ending December of 2024. Notice the range of returns is quite large, going from a high of 12% to a low of 6%. If you would like to spend more time with the data when I show it in full screen, please pause the video to do so. One factor that can frequently explain differences in performance is our asset allocation. Let's go ahead and add a column that shows the percentage of stock in each portfolio and see how clearly this can help us understand the performance difference. This was a great start. Notice that there is a strong relationship between stock exposure and return. The result is higher stock exposure clearly resulted in higher returns. However, the result was not perfect. Using stock exposure alone, both Ramsey and Coffee House should be one level higher. This is not a major discrepancy, but one that we certainly want to explore in more detail. I am going to continue our analysis by looking at FIRE, Buffett, and the Couch Potato portfolios collectively. The reason I am doing this is, even though the results are very different, the structures of these portfolios are almost identical. The primary difference taking place in their asset allocation. We can see this in the data that we are looking at now. Notice the difference in returns between these portfolios can clearly be explained by their asset allocation. One point I do want to make is the Buffett portfolio uses a slightly different strategy. It uses the S&P 500 in short-term treasuries as opposed to total market index funds. However, this structural difference will not have a major impact on the results. The next portfolio that we are going to look at is the Ramsey Portfolio. The Ramsey Portfolio is the first portfolio in the list that uses international exposure. Here is what that portfolio looks like. Including international exposure will help us when international equities outperform their domestic counterparts. It is going to hurt us when international underperforms. International underperformance is what we have experienced this past decade. Not only did international stocks underperform US equities, but they underperformed by a significant amount, almost 7% on an annual basis. The good news for the Ramsey portfolio is their US equities did have a growth focus, and that helped offset much of that concern. The next portfolio that we are going to look at is the 3-fund or Boglehead model. Here is what that portfolio looks like. Like the Ramsey portfolio, it was hurt by international exposure. This portfolio is also the first portfolio on the list that has significant exposure to fixed income. During this decade, Fixed income underperformed US equities by almost 11% on an annual basis. You see this in the returns of the 3-fund portfolio because it underperformed the Ramsey model, which is right above it, by almost 4% on an annual basis. Earlier in this video, I talked about your high-level asset allocation. That is nothing more than your ratio of stocks to bonds. But we can look at stocks in more detail. As an example, we can look at them based on the size of the company. Were the companies large, medium, or small? We can also ask ourselves, did the investments have a growth or value focus? When we look at stocks this way, what started out as one category now becomes 9. This is what I call your sub-allocation. So when we begin to design portfolios, the first thing we need to address is our high-level allocation, the ratio between our stocks and our bonds. The second thing we need to look at is that sub-allocation. I am now prepared to discuss our 2 final portfolios, which is the Bernstein No-Brain Portfolio and the Coffee House Portfolio. Here is what these models look like. When we look at the Bernstein No-Brain model, we see extensive additional exposure to small cap investments. When we look at the Coffee House model, we see significant additional exposure to both small cap and value. There is extensive research that tells us that when we overweight value in small cap equities, this should enhance our overall rate of return or our investment performance. The problem is, during this past decade, large cap growth has outperformed small cap value, and it outperformed it by almost 7% on an annualized basis, the exact opposite of what we would have predicted. This is the danger with trying to overmanage our sub-allocation. But here are the steps to helping you understand and build a portfolio that is correct for you. The first thing you want to do is decide on your overall asset allocation. What percentage do you want in stocks versus what percentage do you want in bonds? Once you make that determination, the second question you want to answer is, do you want international exposure or do you want to go with a pure domestic model? I do have another video that I address why I believe you should include international equities. The third and final thing you want to ask yourself is, do you want to use broad-based market index funds or do you want to try to manage your sub-allocation? Here is the model that I use for myself. It looks like a conservative version of the 3-fund or Boglehead portfolio. Here is the reason why. As I mentioned earlier, I do believe in international diversification. I personally do not want to play the sub-allocation game. Do I know if small cap is going to outperform large cap? I don't have the slightest idea. Do I know if value is going to outperform growth? Once again, the answer is the same. That game just simply doesn't make sense to me, but for you, it might be the way that you decide to create the portfolio that's right for you. I have created this channel to help everyone improve their financial literacy, but I need your help as well. Please support the channel by subscribing. And remember, when it comes to our money, it is always better to be educated than angry.